Panic of 1907. Was speculation the real cause? Imagine a time when the economy seemed stable, then suddenly everything started to fall apart. That's what happened during the Panic of 1907, a major financial crisis that shook the United States. People often wonder if speculation was the main reason behind this chaos. Let's look at what really caused it and see how speculation played a part. The panic started with a failed attempt by some investors, like the Heinz brothers and Charles W. Morse, to control the stock of the United Copper Company. They tried to buy up a lot of shares to push the price higher, but their plan collapsed. This caused big losses for them and made others nervous. When investors saw this, they lost confidence and started to withdraw their money from banks and trust companies. Speculation definitely made things worse. During that time, easy credit and relaxed rules encouraged people to buy stocks and risky investments. Many investors bought assets with borrowed money, hoping prices would keep rising. When the market started to fall, those investments lost value fast. People panicked and tried to sell everything quickly, which made prices drop even more. Banks and trust companies had lent money to these speculators or invested in risky ventures, so when the market crashed, many of them couldn't pay back their deposits. But speculation wasn't the only reason for the panic. The banking system was weak because there was no central bank to help out during crises. Without a central authority to lend money, banks and trust companies faced runs on deposits and couldn't stay afloat. This made the panic worse. Also, a few big financiers held most of the power, so when one failed, it caused a chain reaction across the financial system. The crisis showed how dangerous unchecked speculation could be, especially without proper regulation. J.P. Morgan, a famous banker, stepped in to help stabilize the markets by organizing support for troubled banks. This event pushed the government to create the Federal Reserve System a few years later. The Federal Reserve was designed to act as a central bank, providing liquidity and preventing future panics. So, in the end, speculation was a key cause of the Panic of 1907. It fueled risky investments and stock manipulations that led to a rapid collapse. But it was also tied to bigger issues like the lack of a central bank and weak oversight. This event teaches us that financial crises often happen when risky behavior mixes with structural weaknesses in the system.